Hi, welcome to the World Financial Symposium's Market Spotlight webcast series. Today's focus is on M&A for IT services companies. I'm Justine Iran with WFS, an international organization dedicated to educating technology leaders through webcasts like these and live conferences. Learn more at www.wfs.com. I would like now to introduce today's moderator, Nat Burgess, president of the Quorum Group.
Thanks, Justine, and thanks to the WFS for having me here today. I'm really excited about our agenda, and I'm going to give you a quick walk through it, introduce myself, and then we'll move over to our featured speakers and panel. Today, we're focused entirely on the M&A dynamics of the IT services market, but we're focused on it globally, and we're focused on it with a level of excitement that we haven't seen in this market since 2007, 2008, because there's a lot of activity, a lot of deals, and we're going to go through them in detail. So we'll start with a quick overview of the agenda, and then we're going to move into a very detailed IT services M&A report from two Quorum analysts, and they're going to walk us through recent transactions, valuation trends, and some of the dynamics that are driving high-value deals today. I'm going to give a quick summary on what makes specific companies attractive to specific buyers, and that should give you some ideas of how to build value towards an ultimate exit. Then we're going to go to our speakers. First, we have Rahul Bhandari, who has successfully built IT services companies in the past, and he's going to take us back to just the nuts and bolts of how to build a company that has value, and specifically the 5 challenges to selling an IT services business. And then finally, we're going to close with a founder who's been there and done that, who built a regional services company, who successfully sold it to a global brand, and he's going to give us his war stories of how he accomplished that. So IT services have been growing consistently over the last, well, since the dawn of computing. And that is really a function of the fact that we haven't achieved full automation with computers. So I want to walk us through a quick history of the industry from the early days where we had room-filling computers doing simple calculations on punch cards, and we had to have a staff for every vacuum tube in the machine. And then proceeding on through the minis and micros and the explosive growth of computing, where we needed trainers and training, and where we started to staff up armies of people managing IT departments within large corporations. And that takes us through to the present, where a lot of the computing power has now moved into data centers. But in fact, the need for services and support has actually increased because we're dealing with more integration points and we're dealing with more challenges, and IT, frankly, has become more mission critical to the enterprise. And if we look at how those trends are reflected over the last 20 years, we see some very interesting data here. The top bar shows the total employment in the IT services sector, and then the lower bar shows the NASDAQ composite, which, with the exception of 2000, is a pretty good proxy for the growth of the IT industry overall. And again, as we've seen more computer, more network, more central role of computing power in the enterprise, we've also seen the need for people grow. And if we think back to 2000, well, we all remember the wave of IT services companies that grew exponentially, like Scient. There were dozens. It seemed like everyone I knew was employed and a millionaire on paper at the time with these companies. And then boom, they were gone overnight. But it didn't take long in the early 2000s for the upward trend to start again, for employment to increase, and to bring us to where we are today. And the reason we are featuring IT services on today's webinar is that in the last 12 to 18 months, we've actually seen an increasing velocity of transactions globally, and we've seen some high-value deals, and we've seen some opportunities for entrepreneurs to harvest the value that they've built, and that's what we're going to be focused on today. In terms of Quorum and our recent experience, I've been involved in tech M&A for over 20 years now. I started out at Morgan Stanley before we really had a tech practice, but since then I've managed over 100 transactions, over $1 billion in transaction value. A lot of that has been IP-based, it's been software-based, but over the years we have done a lot of work in services. And while we haven't specifically targeted those companies, we have worked on some game-changing deals. And I would really put them into 2 categories. You'll hear these categories reflected throughout the discussion today. The first is the regional IT services firm with scale. And in that category, I would put RIS up in Eastern Canada. I would put Logos, which was the biggest standalone IT services company in Czech Republic. Those are businesses that reached a scale where they were attracted to global buyers, and we were able to help position them to achieve maximum value with the range of buyers for that type of company. And then the second category is specialization in a high-value area. We have a couple of clients here that focused on financial services. Seek was very strong in that regard. They worked closely with IBM and others. Specialty insurance services had a very strong specialization in the insurance sector. Suncoast with Motorola, telecom specialty. These were all deals where the clients were smaller, but because they had chosen their sector well, they were able to achieve their M&A objectives with their specialization. And then the most recent deal, just a few months old now, was the acquisition of CityTech by ICF, where again, high-value specialization, in this case, marketing services around the old Day software, now the Adobe marketing platform. They built out a very strong business. I don't think I can disclose their scale, but they were closing on $50 million in revenue. They were very successful in their niche, loyal following, and that whole marketing services and support area had become extremely valuable to a range of buyers, and we were able to successfully close the deal with ICF. So it's been an area of some focus for us. It's an area of increasing focus going forward, and we're excited today to present you the data that supports that thesis. And so with that, we're going to turn it over to two of our analysts here at Quorum. Alina Soltis, who's a senior analyst. She has worked on several of the transactions that were listed in the last slide. A lot of deal experience, a lot of experience building out financial models and doing valuation work. And then she has worked together with our new analyst, Yasmin Kodamarati, to pull together the data for today's presentation. So let me turn it over to you, Alina and Yasmin.
Yeah, thanks, Nat. At the start of this webinar, let's take a look at the broad technology landscape before diving into the IT services segment. The valuation matrix here does a really good job of breaking out the components that are key drivers to value, even when applied with a very broad stroke across the entire industry. The first two scales compare revenue and EBITDA multiples found in 2 years' worth of M&A transactions. They show ranges for the first quartile through the third. And then you'll see them further broken out between IT services, software, and SaaS companies. The ability to scale quickly, leverage existing infrastructure, retain customers, these are all key attributes of SaaS companies, which lends them the highest value in this regard, just furthest on the right side. On the other side are IT services companies that depend upon a less scalable resource, staff, that need to be deployed on new customer accounts. So from a multiple perspective, the IT services group has revenue ranges of 0.4 times to 1.4 times and EBITDA multiples between 6.4 to 13.4. Looking further beyond the financial metrics, the X factor that drives additional valuation premiums is the specific market position and opportunity that the company finds itself in. Those companies that are highly specialized, that provide a service or solution that is in market demand, find themselves towards the higher end of this range. And then if we look more specifically at value drivers of IT services, created the following key indicators of value. These ranges are calculated from publicly traded companies, beginning with growth. This is a key consideration factor and value driver. Only a small portion of public firms are growing over 15% a year, which is the rightmost range. And in fact, Forrester expects the IT services market in the U.S. to grow at 6% this year. Now, comparing this to companies looking to be acquired, high growth is necessary. Public companies' main goal here with acquisitions is growth and expansion. The next metric is the rate of efficiency as measured by gross margins. Our research shows that if gross margins are under 20%, don't expect a valuation over 1x revenues. The firms that we worked with that have had utilization rates of 75% or higher have made very strong impressions on buyers. Their strong management policies provide confidence during such an M&A event. And lastly, revenue per employee is an important metric that conveys the effectiveness driven through each member of the team. To caveat, these are total employee counts, and with the intention of providing valuable feedback for our attendees, the way that we've organized this chart is to focus on the metrics on the right. This is the attractive territory that you want to find yourself in. So moving on towards the public peer groups, this is a view of monthly performance within the developed markets. This includes companies within North America, Europe, and Japan. We've had a steady year in valuations with a nice increase towards the last 2 months, now putting us at 0.89 times revenue and 9.8 times EBITDA. The geographic differences do drive quite a variation in valuations, where there's a lot of new growth and lower costs seen in emerging markets. And here we see 3 times higher revenue multiples and 50% increases on the EBITDA multiples. As a comparison to the steady growing rate of the developed markets, emerging have been much more volatile over the last 12 months. Over the November-December timeframe, India's election cycle brought in a new presidency who's been received very positively for his pro-business views, which caused a jump there. Soon thereafter, the rupee neared lows against the dollar, going back down, and then a surprising rate cut in India led back up to the shoot. So a lot of this variability across the valuations has really been driven by outside forces rather than the underlying business fundamentals of the IT services companies. The market for publicly traded IT services firms is found on the U.S. stock exchange with about 65% of the total share, and then another 20% on the Asian exchanges. What this means for potential acquisitions is the strong cash stores coupled with shareholder duties to continue growing and expanding represents very strong deal flow coming out of the West. This in turn has resulted in $13.6 billion of acquisitions originating from the U.S. in 2014. The European market represents almost as many transactions as North America, but with consolidation happening on a smaller scale. With Latin America, a lot of the companies like Sonda and Cello have been quite active, building up within their major Latin American communities and countries there. So taking another stab at that information, the data here shows that about 3/4 of the M&A value is in the Western economies, with 2/3 the deal volume. I know this is a very rich set of information, and we'll make these slides available after the presentation for deeper review. Now turning to the annual M&A activity, tracked back to 2008, when we had a hit record of $35 billion in transactions. This last year in 2014, we actually ended up beating the total transaction count, recording over 1,000 transactions. This tracks very closely to both public market performance as well as broader tech M&A cycle, with a strong rebound seen this year, a 57% increase total deal value year on year. But an important distinction to note is the lagging effect that IT services has had against the general tech M&A cycle. The below chart shows the strong outperformance and record year in 2014 across the broader tech M&A index. This means we expect another strong year for IT services M&A activity, likely maybe even beating 2008 levels. The most active companies have acquired for the purposes of expanding offerings, new customers, and getting new teams of specialists. Both Accenture and Hitachi were on the top here with 4 deals each in 2014. Accenture had reached out to acquire 2 Oracle-based services shops, plus a digital agency and a CRM specialist. Meanwhile, EPAM, with their heavy Central and Eastern European presence, grew with 2 U.S.-based companies, plus an Armenian company. And 2 of the 3 deals here also focused on the healthcare sector. To continue growing its market share, Iron Mountain had moved into emerging territories, acquiring Brazilian, Polish, and Turkish companies. Taking a look at this slide, this is an interesting view on the sizes of the targets. So you'll see the vast majority of the deals here are sub 50 million, slightly increasing between 2013 and 2014. And note also that the scale changes in this range. So in 2014, there were 251 deals done in the sub $50 million range. The deals under 250 million received a lot of influx and attention over the last 2 years as well, with strong deal traction. And lastly, looking at the significant increase in billion-dollar transactions, they contributed $14.4 billion of the $26.7 in total deal spend in 2014. Yeah, so you've been looking at some recent transactions, right?
Right. So in the developed markets, the biggest IT services firms
having undergone significant domestic consolidation, are now looking for growth internationally. For example, French firm Atos acquired Xerox's IT services arm for just over $1 billion, making them the largest European-based IT service provider and tripling their presence in the U.S. IT security services and information security VARs were particularly popular as highly publicized breaches in cybersecurity underscore its growing importance in the private and public sector. After being bought by Blackstone Group earlier in the year for $225 million, the network IT security company Accuvant announced its own cybersecurity purchase with the acquisition of Fishnet Consulting, an information security solutions provider combining two of the largest security companies. Now, in emerging markets, companies are maturing and growth is crucial. In Chile, IT services firm Sonda paid $170 million for Brazilian IT provider CPIS, expanding its reach into Latin American countries with high growth prospects. In India, cloud development services and consulting firm Aditi Technologies was acquired by Symphony Teleca, becoming its fifth division, focusing on what Symphony calls systems of engagement, applying cloud mobility and analytics. And this latest deal is another example of consolidation, this time in the government space with SAIC purchasing Cytor for $790 million at a 1.3x sales multiple and 10.6x EBITDA multiple. According to SAIC, Cytor's classified contracts within the intelligence sector and Air Force, coupled with limited integration risk, are synergistic strengths.
And that wraps up the IT Services M&A report. Back to you, Nat.
Thanks, Alina and Yasmin. That's incredible data as all of us, as our guests today, are thinking about building value, thinking about driving towards M&A. I wanted to make a couple of overarching comments before we go to our panelists. And the first relates to geography. As Alina and Yasmin showed us, we're seeing about 51% of the deal volume in North America. But if we look at a recent poll of CEOs regarding where they intend to buy, we see 73% intent to buy in the U.S. market. And this is not just IT services, this is M&A overall. And then we see a much smaller percentage as we move east. Now, of course, we are seeing interest out of China and out of the East in buying companies in North America. And we're also seeing, interestingly, companies that have a predominantly CIS footprint concerned about the disruption there and now looking to Latin and Central America to diversify their bases. But overall, as we learned today, a lot of the money and a lot of the focus here is still on North America in spite of the explosive growth of IT services in the international market. Let's think about it slightly differently now. IT services demand tends to follow technology trends overall. So if we look at where the most aggressive buyers are making the most deals in the tech market, we'll have a pretty good clue to where the highest demand for IT services is today. And what you see here is dollar volume and number of transactions in different segments, smart mobility leading the way. And it's no surprise then that expertise and skills in this area are extremely high value. We've actually had a number of discussions recently with mobility-focused IT services companies that have been approached, that are in talks with buyers, and that are trying to figure out the best way to move forward. So again, high-value markets with consolidation drive demand for IT services. Cloud and SaaS is another area where we've seen a lot of interest, a lot of activity. And then as we saw earlier with our transaction in the marketing space, advertising and marketing technologies are red hot right now. And we're seeing on average 2 to 3 firms a week that specialize in that area that are having some level of dialogue with buyers. And then we get into the more specialized areas like payment gateways and financial technologies. High demand, a little more niche, a little more focused, but I wouldn't take the low deal count here to connote lack of interest. We're still seeing a lot of activity there. And a lot of activity in the specialized areas like security. Note that this chart shows the segments where there's been a significant amount of activity. So if they're on the chart, they're pretty interesting. And if they're not on the chart, we might second guess the wisdom of being in those markets in terms of building a growth business. So we're going to basically transition now from the financial data to the tactical experience and skills required to get a deal done in this market. But before we do that, I just wanted to make a couple of closing comments on the data section of this presentation. If you are building an IT services company with an eye towards building equity value and building towards exit, there are a couple of key things you need to be thinking about. The first, as we saw from Alina's presentation, is that EBITDA is the key financial metric. If you're building a SaaS business, it's top-line growth. But if you're building a services business, it matters a lot that you've got a discipline in the company to be profitable, because your contracts are probably short-term. You don't have a lot of residual value, a lot of IP in the business. So the real question is, are you building the business with the discipline to remain profitable? The second is growth. We saw data from Forrester saying IT services is going to grow 6% this year. Gartner, sometimes I think I see 3%. We actually are much more confident. We think it's going to grow as much as 15% this year. And that means that if you're growing significantly slower than that, then it's possible that you're not going to give these bigger companies the edge they need in terms of growing faster than the market. So EBITDA first, growth second. The third thing I'll point out is scale. If you're a general IT services firm, regional firm, scale matters a lot. At 5 or 10 million in revenue, you're not really a target yet. At 30 to 50 million, you start to get on the radar. And the idea is that you've grown past a founder and a cult of personality around an individual. You now have a real company with middle management, with repeatable sales process, with control over your delivery, and you now have value to a buyer. So that's true for the generalist firms, but smaller firms that have a high-value specialty like mobile, like cloud, SaaS, security, if you zeroed in on these areas and you've built a high-value team, then you're going to have value earlier in your life cycle, even when you're smaller. And we can point to many examples of that among our clients, like Specialty Insurance and Seek. And in the broader market, there was a firm that Groupon acquired, for example, that had a very, they had, I think, the single largest concentration of Ruby on Rails specialists out in the wild, and they bought it. They came to rely on it, and they had to buy it. A relatively small company, but a critical acquisition for them. And then the final point is geography. And here, if you have a headquarters in Ukraine and most of your customers are there as well, these are challenging times. If you successfully expand to Germany and you have a lot of customers there, now you have more value. So we think about geography both in terms of where you're located and where you're doing your delivery from, but also where you're building your customers. And frankly, the more developed geographies are higher value in terms of acquisition. So that's what the data tells us. At this point, let's go to our experts who've actually been through building companies and selling them, and let's get a more tactical view on what it takes on the ground to build towards a successful M&A transaction in the IT services industry. Our first speaker, Rahul Bhandari, former senior exec with Accenture, senior exec with Oracle, has built companies in this segment, very strong concentration and experience in the government sector. He's also run a VC firm, and his perspective is both as an operator and builder, executive with the very large companies, and an investor. So over to you, Rahul.
Hi, I'm Rahul Bhandari, Senior M&A Advisor with the Quorum Group. We are seeing an uptick in demand for quality IT services firms, with almost $27 billion in M&A spend on over 1,000 IT services transactions for 2014 alone. IT services firms in particular have a unique set of challenges that they must address in order to become an attractive acquisition candidate and to command premium value. I will share top 5 challenges to selling IT services firms based upon my 2 decades of experience founding and leading IT services, mergers and acquisitions, and venture capital at Accenture, Thomson Publishing, Oracle, and CSC DynCorp. Low valuations. IT services companies usually attract lower valuations when compared to software products companies or a company that has both services and products. Typically, we see the valuation in the range of 0.7 to 1.5 times revenue. Typically, intellectual property is table stakes and inherent in delivery of client services, and as such are not valued as highly in an IT services firm. To increase the value of an IT services firm, focus must be on high margins, high customer retention, year-over-year growth, same client account growth, diversity of clients, and tech talent that is in high demand. The right buyer. Since most of the value in an IT services firm is in the growth, revenues, margins, client base, and technical talent, it becomes even more important to find the right buyer who would value these assets properly. The right buyer may be a strategic overseas buyer or a government contracting services firm. The overseas buyer is typically looking to enter new markets, expand their client base, or acquire new capabilities. An IT services firm whose primary client is the government typically is looking to diversify their client base into the civilian sector, acquire new capabilities, and highly skilled and qualified talent. Talent retention. It's a unique aspect of an IT services firm that its most valuable assets walk out the door every evening and may not return the next day. The war for talent today is at a global scale, and talent finds its own level. Efforts must be made to attract, retain, and nurture talent to create value in the IT services firm. As such, talent retention must be of paramount importance in how an acquisition deal is structured, such that there is more growth and promotion opportunities as a result of the M&A. Outsourcing. IT services firms are particularly susceptible to this challenge, especially from overseas strategic buyers looking to jack up their earnings using a modified private equity model. In this scenario, the buyer typically looks to replace the high-paying tech talent with outsourced services or with low-cost labor. IT service firms can build solid protections against this option to attract high valuations. This includes a highly trained and experienced staff with specific industry certifications and knowledge, portfolio of capabilities, a solid track record of past performance, and deep relationships with clients. Integration challenge. The open secret about M&A is that most deals fail to generate the synergies companies expect when they announce a merger. This is especially true for IT services firms where earnouts are typical. Since IT services is inherently a people-driven business, it is important to evaluate compatibility of the cultures, the organizational structures, and the decision-making processes on how the client value is delivered. There are, of course, several other challenges to selling an IT services firm, including achieving synergies from combined companies, transition to a professional services firm, keeping the customer firm first in an M&A transaction, and properly valuing IP assets. So we see that addressing these challenges proactively prior to going to market increases the valuation and makes for an attractive acquisition candidate.
Thanks. Great advice, Rahul. And at this point, I'd like to transition next to Ray Makala. And our guest today, we have dozens of IT services CEOs on the line joining us for this market spotlight. And I know the data is useful to you, but I also know that you're all operators. You worry about making payroll every other week. You're building businesses. And Ray did the same. Ray and his partners bought out a services firm, grew it as a regional firm until it had a national profile, or at least it got on the radar, and then successfully sold it. And the reason I invited Ray to join us today is because he can speak to two core questions that I think are in front of every CEO in this sector today. The first is market timing, and the second is how, as a regional firm, you get the attention of the international players. So let's go to Ray now.
With us now we have Ray Makala, who is the founder of Codesic. Codesic was a regional services firm that attracted the attention of an international firm that wanted access to the Pacific Northwest. Interestingly, Ray and his colleagues sold their business at the peak of the market in the last cycle. And as we're watching all the economic indicators today, everyone's wondering, is it a bubble? Is it a robust market? Is it getting frothy? And how should I be thinking about market timing? We don't get the benefit of hindsight when we're in our current cycle, but if we go back to the last cycle, we can look at some of those dynamics. So, Ray, welcome. I'm really glad that you could join us today. I wonder if you could start by just giving us a brief introduction to your company and how you guys got started and how you really got set up to the point where you were ready for an M&A event.
Sure. Going back several years, we had an IT services company servicing mostly telecommunications, high-tech, and public sector clients here in the Puget Sound region.
You guys sold at the peak of the market, so that had implications for the appetite of buyers. I'm guessing it had some implications for ultimately what the deal was worth to the sellers. But here we are 6 years into one of the longest running bull markets since World War II. We're starting to wonder how much longer it's going to last. Going back to when you sold, did it ever cross your mind at the time that you were at a peak? Did the external market timing play into your decision?
I wish that we could say we were that omniscient and had thought about it. I think we felt that the timing was good for us. And looking at some of those classic factors, the personal motivation, the financial motivation, and maybe the strategic motivation to sell, we had gotten to a point where we thought, both from a strategic and frankly a financial, we were at a point where we thought that there was good value in the business, that it was time to take a look. And so I would say that was a bigger factor, but also we realized that it is a bit like time in the stock market. If you wait too late, that's going to be the most expensive mistake. So I think once we felt like we were ready to take a look, we moved pretty rapidly from that point forward.
Yeah, it's interesting. You look back and you say, I should have scraped together every penny I could find and put it all in the NASDAQ in 2009, 2010, but at the time it's a different mindset. You're basically, you want to put everything under a mattress, and then when things are good, everyone takes risk, they borrow money, they buy in at peaks, and then they pay the price later. That's just psychology. And I've been through 3 or 4 of these cycles now, but definitely recognize that psychology doesn't change. So, I mean, fact is everything can change tomorrow, and then we'll second guess everything we did. But in terms of the market timing, our view has been that there are certain markets where in a peak market you can sell at a good valuation, and in a down market, you can't sell at any price. And unfortunately, that has been particularly true in areas like IT services, where you are considered an external cushion for internal costs. And, the first thing people cut is those outside resources before they start cutting into the core of their business, which means you're especially vulnerable to market cycles. Do you have a similar view of that? And do you think that if you guys had waited for a year or two, potentially you wouldn't have been able to sell at any price?
Well, I think it certainly would have been a different conversation, and especially given the timing and some of the things that were happening with our large clients, that we didn't know at the time, but that were in the works. So I think, yeah, absolutely, it would have been a much different story had we waited. And again, going back to kind of the strategic decisions, I think when we were looking at, we needed some mechanism to go offshore. We needed some mechanism to open up some other branches. It wasn't something any of the partners had direct experience doing on our own. And we also felt like a global brand would give us more leverage from, a pricing and rate perspective, that, the timing was good strategically, and it felt like it was a reasonable time in terms of the business was healthy, it was growing and stable. And so, those were enough to say, yes, it's time to pull the trigger. That was the point that we decided, because of the strategic drivers, that it was important for us to look to a global partner that would give us more access, better brand, a little more leverage, and some other capabilities. That, given that it also looked like a reasonable time in the market, compelled us to make the decision to go to market, and had a lot less to do with trying to time the exact timing, though, looking back, I think we probably hit it at a pretty good time from a cycle standpoint.
Yeah, no, I would agree with that. So just a final question for you, Ray. If you were to build a similar business today with an eye towards being acquired, what are the 2 or 3 things that you would make sure that you did in order to maximize value and survive due diligence?
It's a great question, thinking back through the journey and as we went through that process. Again, I think having strong client relationships and, really protecting and investing in those. We had dedicated account managers and really spent a lot of time maintaining and fostering those relationships. At the end of the day, that was probably the biggest driver in our value creation. The other piece is having the processes, having the infrastructure in place, being able to show the value we were bringing to the clients, beyond just the billable hour and the resource on site. And, frankly, now I think I would look much more to leveraging tools and technology as a way of delivering those services so that we could show scalability and repeatability. And, it's a little different world, or there are lots of different options and ways to do that now that I think would make you even more, profitable and scalable beyond, again, just the billable hour.
Well, that's a great point, and I know you're doing some of those things now in your new business, but that's another story. So, Ray Michaela, thanks very much for joining us today. We really appreciate it, and good luck with your new venture.
And my apologies to Ray Michaela for pronouncing his name wrong. We're at the end of our 30 minutes. We're a little bit over, but at this point, I wanted to thank our host today, the World Financial Symposiums, and Justine, thanks for having us. The research data that we shared was developed by the Quorum Group and will be made available to the attendees today. I appreciate your joining us, and we look forward to a conversation or having you on the next event. Thank you very much.